Good morning everyone and welcome back to Morning Markets here at True Potential. It's Kevin Kidney and today I'd like to build on some of the messages that Chris Leland put across yesterday regarding the surprise downgrade to the US Treasury credit rating. And we'll also show you how that impacted on the equity market performance globally yesterday. So as Chris Leland indicated yesterday, there's likely little consequence or read-through for markets from the surprise downgrade for US Treasury credit rating yesterday. There have been downgrades before in other markets, and markets have often been able just to carry on and look through it. But what we do think is impacting global markets currently began with a surprise adjustment to monetary policy from the Bank of Japan on Friday. They have indicated they're going to allow the yield on the 10-year government bond there to rise modestly towards 0.6% and even above, and use their existing tools to control it there. But that had the impact on other bond markets of yields rising in sequence. And then on Monday, we had the surprise announcement from the US Treasury that they're going to increase the number of US Treasury bonds that they issue over the next quarter. And this is because of the fiscal deficit in the US. So they're going to have to issue more government debt to fund Bidenomics. That is the investment the United States government are making in things like the Inflation Reduction Act and the requirement to finance that from the bond market. And then the third consequential impact on bond markets was yesterday. Recall that we've had surprisingly strong growth in the US this year. Q1 GDP was revised higher. Q2 GDP came in last week, much stronger than markets expected. And we've had the first projection for growth for this quarter, and it's almost double what it was at the end of last year. US GDP may be growing somewhere between 3 to 4% for this quarter, and that's remarkably strong for an economy which has endured over 500 basis points of interest rate hikes and has had quantitative tightening, that is the Federal Reserve selling bonds back into the market. So each of these three steps, from the Bank of Japan through to the US Treasury funding announcement, and now the projections for US growth, have impacted the bond market and yields have risen. That is, US Treasury bond prices have fallen, and this has impacted broader asset markets such as global equities through the start of the week, but also global commodity prices. And I've seen that on screen. The oil markets fell yesterday. Markets right now are just not comfortable with the idea of much higher bond yields, particularly in an environment where it's accelerating growth and accelerating bond issuance. Last year there was a struggle with accelerating inflation and accelerating bond issuance, and now it's growth. So what we likely need to see for markets to calm down ahead is a further soft print in the next US inflation publication, which comes next week. So this is what's dominating markets right now. It's the bond market. And this takes us on to interest rates from the Bank of England later today. We're expecting another increase in base rate. However, the bank may acknowledge that inflation has come in slightly softer recently and may look to temper their language somewhat and indicate that there are only a few hikes left before we get to the terminal Bank of England rate. So please do join us tomorrow. We'll update you on that. Thank you very much.